Hello and welcome to another episode of Nothing Ventured with me, Aarish Shah. Today in the studio with me, I have Manish Karani. Manish is the founder of Euretta, a science-backed AI tool that analyzes personal traits, values, and past experiences to forecast future success for corporations and investors. Prior to founding Euretta, Manish spent 5 years at Coutts, working across Switzerland and Singapore. He then launched a multi-family office investment vehicle managing investments for 28 ultra-high net worth families, deploying £15 million across real estate and venture capital. With over 30 investments, he achieved 23% IRR in VC and 14% IRR in real estate. And in 2023, Manish launched a £30 million fund focused on the plant-based sector with Sentient Ventures, an early-stage VC fund, but ultimately decided to return the funds to the LPs. In today's episode, we talk about why Liz Truss impacted the consumer tech space, how Manish decided to return capital back to his LPs, and more importantly, why, how Crucible events change your perspective and change your life, how non-UK LPs have fallen out of love with the UK, or whether they have, investing in hardship, alienation, illness, and loss. It's not the event that you're measuring, it's the individual's process for managing the event, and that can be measured. Whether or not you can measure mindset, and how there is a 95% correlation between hardship, alienation, illness and loss, and successful entrepreneurs. Quantifying entrepreneurship potential via the 27 traits of entrepreneurs. Let's get straight into it. This is Nothing Ventured with me, Aarish Shah, the podcast where I talk to the people behind the stories that make the venture capital ecosystem go round. I've been working with startups from pre-seed to Series C for the last decade, and companies that I've worked with have gone on to realize value and exit, or raise funds in excess of $500 million. I really hope you enjoy the episode, and if you have a guest that you'd love to see me have on, or you have a comment on any of the episodes that I've recorded so far, do reach out to me on LinkedIn or Twitter. I'd love to hear from you. Let's get straight into it. Manish, really great to have you in the studio. Thank you for making the trip all the way over from the US just for this podcast. At least that's what I tell myself in the evenings, but really wonderful to have you in the studio with me. Thank you so much for joining.
Thank you.
We're going to dive straight in, right? So this is a podcast that's focused on the VC ecosystem. We've seen some pretty tectonic shifts in the market over the last couple of years. So I'd like to explore the genesis of Sentient Ventures and how you made the decision to close that fund and return capital back to LPs earlier this year. Because it feels like there are probably a number of emerging managers out there who have struggled with this question of whether they should keep trying to raise their first fund or indeed if it still makes sense to keep their fund going. And I think your learnings and process would be incredibly valuable to understand. So yeah, would love to understand that a bit more, maybe even what sort of triggered your move into setting up Sentient in the first place.
Yeah, so look, I think I break this down into two things. I think you've got the sort of the business / financial side of running and being part of a fund and owning a fund, and then I think it's the second bit is actually the reason why you set up the fund in the first place, right? You know, because at the end of the day, running a fund it's a full-time job, and you know, a general on average a fund life is what, between 7 to 10 years, right? So that's a big chunk of your life that's going to be focused on this. It's a big commitment. Look, in terms of on the financial and the business side first, because it's probably quite easy to kind of quantify. I think, look, obviously we raised $40 million. Honestly, I think the Liz Truss announcement was a big difficulty for us because we did a lot of consumer direct. It was Sentient was a plant-based, so focused on food tech. And we did a lot of space in the consumer space, investments in consumer and removing animals from the supply chain. And I think post that event, and I think with the inflation issues, obviously with food crisis, with cost of living going up, I think that industry in itself just became quite difficult to find investment opportunities. What I would say is there was a lot of money flowing into this kind of area over the last maybe 5 to 10 years. I mean, the likes of Beyond Meat, the usual suspects. That's really taken the hit over the last 2 to 3 years. I think a lot of the sort of subpar brands that couldn't really get their taste profile right or couldn't get their cost profile right actually disappeared over the last 2 to 3 years.
You don't hear about many of these as much as you used to, for sure. Yeah.
Yeah, exactly. I mean, you can just kind of read the news and stuff. It's it's not been great. So I think, you have to kind of be honest with yourself as a fund manager, right? We raised the money. We were trading. We were actually looking to make investments for about 2 years. We only made 3 investments, and they actually happened within the first 6 to 7 months of launching the fund. But post that, we were just waiting. I was very adamant that I didn't want to, with my colleagues, that we didn't want to deploy capital.
Just for the sake of it. Yeah.
Just for the sake of it. And I think the valuations, a lot of businesses, either they ran out of cash, or a lot of the founders, entrepreneurs, which is fair enough, just didn't want to do down rounds, they didn't want to dilute. So we were kind of just waiting, right? And then what you started realizing is there was so much capital that moved out the space. So then who's going to be your exit opportunity? Who's going to buy? Like, we invested pre-seed, seed, just before Series A, but who are we going to sell these business to? Obviously, we're a venture capital firm. We have to have a buyer. And I couldn't see in the next 5 to 10 years any serious buyers coming in, especially in this area. So from a financial perspective, it was just like, either we can just sit here and, to be honest, take management fees, which is, why not? But it just didn't sit quite with myself and my fellow GPs. So I think on the financial side, there was kind of the main core reason. And like I said, I think you're committing 7 to 10 years of your life to something like this. Of course, you can go out there and raise a second fund and a third fund, but I'm going to kind of look at it quite logically here, right? $40 million fund, maybe you'll 3x, 4x your return. So you get about 120 million,
20
if you're
million
lucky,
carry.
20 million carry, you split that between the GPs, and you're like, 10 years, 7 years, is it really worth it in terms of on the financial side? So I think that was kind of the main sort of reason behind it. I think in terms of me personally, like I said, I think there were specific events in my life. Scientifically, Harvard Business Review did a course. Did a survey on this, and they call these crucible events. So this crucible event essentially is an event in an individual's life that doesn't fit their existing mental mode. So it's something that they just can't explain through logic. So that might be a loss of a parent. That might be, something that you were mentioning about some of the people that you've lost in your life recently. And actually, these two I've had 2 of these which really hit me quite hard. And I think when these crucible events did happen to me, that was when I made big shifts in what I was doing with my life. So the first one was when my dad passed away in 2016. So I left investment banking. I was living in Singapore, came back, and then I launched my first that's when I launched my first investment vehicle, which was a multifamily office. But it was the first time of me being an entrepreneur. So that was kind of my first go at it. And then really from 2010 to 2022, I've been investing, right, for 12 years. 2016 to 22, I'd been investing on my own accord with teams, but it was essentially my fund. I built the funds together, the investment vehicles together. And I think I had a crucible event in 2021. I had a very, very difficult divorce from my ex-wife. I can be honest. I'm going to mention names. It was quite. She was a very. It was a really difficult time, right? Health-wise for me, and at that point, we raised the fund. And also I was kind of going through my own crucible event again. I'm like, is this really what I want to do?
Were you going through the motions almost to some extent?
Yeah, I was going through the motions in terms of on the fund. And look, my personal life was going through a real hardship. I think, it was a really difficult period. And I think at that point, a lot of the difficulty that I faced when my father passed away, which I didn't really grieve and didn't really reflect and have that stillness about why I'm setting up the first fund. I just did it because I thought I've been in investments, I can do this. Maybe this is the right thing for me to do. And I think the second time around, it was very different when I was going through this hardship because it was a very long process, our separation, right? And it was a difficult process. So I kind of had maybe like an 18-month period where I really got to know myself. I really got to reflect. I had that stillness. And I think at that point, I kind of made this decision that I don't really want to be investing anymore and I don't want to be a fund manager anymore. I think I realized that honestly, the reason why I became an investor in the first place was because I wanted to make real difference and I wanted to support founders, unbelievable founders in achieving greatness across their specific industry. And actually, our first investment vehicle was very much an impact focus. So it was a do good vehicle. When we launched the second fund, I was going through this hardship. I actually realized that I became an investor actually because I feel it was an insecurity on my behalf. Think that I actually not good enough to be a business owner, an entrepreneur. So I think this second Crucible event,
so I'll fund.
Correct, and I'll fund people that are really good at what they're doing, and they really want to make this work because they've got their own specific reasons behind it. And I think there was that event, right, when I was going through my divorce, where I was like, well, actually, I think I can do something just as good, and maybe bigger than some of the companies that I've backed within my specific vertical. And I think that helped me a lot with identity, right? So I think I kind of found my identity over the last 18 months because, you kind of hit the floor and you're like, okay, what am I here? Who am I? What am I doing? So look, I think that was also one of the core reasons why I shut the fund down and I spoke to the LPs. I said to them, look, I believe I'm on this planet to do much more. I don't think the size of my ambition in terms of the number of people I want to help is big enough in only a 40 million fund. I don't think people have, I don't think like no one can kind of do what I specifically want to do better than me. So I think I've got to make a decision. Either I keep the fund open and continue to live myself, and I'm happy for you to replace me as a fund manager and I'm happy to kind of take a step away. Or, I give the money back. We stay supportive of the movement. I still advise some of the companies, still sit on some boards, but actually this is going to allow me to do something which gives me true meaning. And they got it. So look, I think it was, it's so important. I think it was just like, I think this event the last 2 years really allowed me to really understand why I've launched this fund, and it wasn't aligned to who I was as an individual, which I really only found out, I think, over the last 18 months.
Yeah. So there's a couple of things. That's an extraordinary story, and thank you for being so honest about it, because I think, others maybe in your position might have obfuscated and maybe said, there are other reasons, but you've clearly owned up to the fact that it wasn't where your heart was, and therefore that it wasn't the right thing to pursue. I think the couple of things that come out, obviously, one of the things you said really resonated in the sense that, a lot of therapy, as an example, is about breaking yourself down right back and then building yourself back up again. And I think, a lot of us, and I think you and I have probably grown up in relatively similar sort of circumstances. We build up these images of what we should be based on, pressures from family or, the communities that we grow up in or the schools that we go to. And you sort of fall into this path of, okay, well, I'm going to do this because it's the right thing, that, that's what's going to satisfy, those people. And that's, that's what I've always been told that I should do. And I'll do the next thing because that's the next logical progression from that. And you end up sort of 10 years, 15 years into your life, or into your adult life, maybe, basically having moved forward without intention, maybe is a good way of putting it. I'm not saying that you didn't have any intention for any of that period, but certainly I found, exactly to your point, the intention comes when you're actually at your most vulnerable, right? When you're sitting there going, geez, what, I remember coming back to the UK in 2015, absolutely just no idea what I was going to do. I had no relationships, had no network. I'd been away for 10 years. My CV meant nothing. Recruiters were like, wow, this is great, but there's nowhere we can put you. And so I had to figure it out. And actually, when I figured it out, and it took me, I figured it out, I was lucky to get in where I got in 2015, but it opened my eyes to the other stuff that was there. And actually, over time, I realized that, what I wanted to do was help people and help founders and help businesses. And actually that's kind of how I built everything I've done since then. Right. So I think you know, to your point, these crucible events maybe are those, you know, the mirror shatters, but then you put it back together again. Right. So I think that's incredible. And we're going to talk about this obviously during the podcast as well, but clearly there is this problem, not just with VCs, you know, but founders, you know, a lot of whom have imposter syndrome, but a lot of whom also just doggedly move forward despite everything telling them that this is not, you know, they're unhappy, they're not, you know, their physical, their mental health has all suffered, but they're just, you know, they keep kind of plugging away because they just think it's the right thing, or they're going to disappoint investors or employees or their partner or whoever it is. And I think that's a really negative kind of, it's a negative situation that I think is perpetuated, you know, far too often in the kind of ecosystem. But the other thing I just wanted to ask you, right? So this is slightly less deep, to be honest, but you know, hindsight is really a wonderful thing. You know, you mentioned the Liz Truss mini budget. I mean, was it existential at the time, or did that only become apparent after the fact? After a few months, you're like, geez, this has really just shaken the foundations of what we're doing. The whole consumer market has just, you know, dried up. People don't have cash in their pockets, etc. Or as it happened, we were like, well, this is gonna really just mess us up. Like, how did you think about that?
Yeah, look, I think Liz Truss's announcement, like we had two deals that we from our first fund that we were going to exit, and we were in 3 months of due diligence, so final legals, commercial, everything had gone through, and two of them fell through because the larger the firms that wanted to exit us out, and some of the founders were like, you know, we just don't know what's going to happen with the economy now. Yeah. So we straight away, like, it hurt.
It impacted straight off the bat.
Straight off. And then I think, but then, you know, then you kind of take a step back and I guess similar to you know, to any sort of cycles, you kind of start looking at your underlying portfolio, and even as an entrepreneur, you start, because at that period before that, you're really pushing for growth to hit metrics rather than profitability, right? And I think then her announcement, suddenly everything just went up and down.
Yeah,
right?
On top of the market in general, the VC kind of market in general, having had that sort of shift away from growth at all costs to more efficient growth as well.
Correct. Yeah. So I think, look, end of the day, so those companies, we tidied them up, right? You know, you kind of have to, you clean the balance sheet, you start looking at teams internally, you know, do we need this many people? Do we start rationalizing, can more people do more? How do we remunerate the better people? How do we bring in the right team? So you kind of, that just start to get accelerated quicker. And I can't blame that just on Liz Truss, but I'm saying, like, I think as an ecosystem, as an infrastructure, these are things we have to be on top of anyways, right? Before.
And they weren't expected. I think the problem with that was it was a shock to the system that most people had not been expecting.
But you know what? And I think you'll get this because you mentioned you came back in 2015, right? Like, and you asked me about Silicon Valley versus the UK. And I think politically as well, this country has been very difficult, right? I came back from Singapore, relatively stable.
Yeah. So we made the decision in 2013 because, like, okay, global financial crisis hit hard, but we started seeing shoots of recovery 13, 14, 15 when we came. We're like, okay, this feels like a good place to be. And then 2016 came along and knocked us all for six, I think.
Yeah, so I think, look, you know, we obviously had Brexit, and then we had COVID, and then we had we've had constant election changes. We had, you know, the drama that's gone around Boris and all these kind of different things, and then Rishi. So I think it was actually naive of me to not be prepared for these situations now, unfortunately. You know, I think I remember when we raised our first sort of investment vehicle in 2016, it was, you know, the majority of the capital came from the Middle East and India and Singapore. And they were like, yeah, UK is a safe place for it to be held. And that view has just changed now.
Yeah. So actually, can we just dig into that for a second? Because I think that's super interesting, because obviously a lot of LPs into a lot of UK firms are APAC, Middle East, UAE, etc. Do you think that perception has persisted even today?
So look, there's two types of money. I think there's institutional capital,
Mm-hmm.
the big funds, the sort of even the small funds, but institutions where they have a much more structured approach to investing,
Mm.
right? So they will still invest in the UK or Europe because they have allocation to put into these countries, irrelevant of some of the macro. They will still keep an allocation. Whether they increase it or reduce it drastically is different, but they will still put allocations there.
Yeah, because it's part of their
It's just part of their mandate, right?
Yeah, sure.
And then you get the other types. You've got the high net worth angels. You've got the family offices. The ones that kind of write, anywhere between 100,000 up to maybe $15 million dollar tickets into a fund or into a country or whatever. I think that money's much harder to bring into this country, right? So when I announced that, I'm shut the fund down, I think whenever it was 3-4 weeks ago, on like, honestly, I probably had about 7 or 8 fund managers approach me saying, "Can we have a chat because we want to discuss, basically if you know any LPs that want to put money into our fund." And I said, "Look, the majority of the capital that I used to manage is not UK based." And I'm being honest, right? It is hard to get them to put money in this country at the moment. Capital gains tax is potentially going to go up in a month, or whatever. And it's like, look, I've personally, me and my family, we put 20% of our wealth back in India over the last 4 years, right? The returns that we're getting from the stock market through passive is unbelievable compared to here.
Why would you take the risk?
So, and now again, like, Saudi Arabia is doing well, right? Dubai is doing well. India's doing well. Politically, they're also more stable. Well, they have been over the last 5 to 10 years. Economically, there's a story.
Yeah, and they have GDP growth and they have growth in there.
Correct.
And they're also attracting both foreign investment as well as foreign talent, whereas the rest of the West, or the West, seems to be rejecting.
And quality of life in these places has become, give or take, most people think it's better. Most people are moving.
Yeah.
So it's hard, right, to raise money. And I think if you're a UK based investor and you kind of UK or West is your thing, then it's kind of fine. I get it. But if you're not, it's hard. I find it very difficult. I think it's going to be difficult. And I'm also basing it on the returns of a lot of the funds, right? In India, you FTSE 100, the local markets, the Nifty 50 and all these types of, they've just done really well. And it's, fine, if you do well as a fund manager, you might get 20 to 25% IRR. In India, on stocks and shares on the market, you probably can get 12 to 15%, and it's liquid.
Yeah, not zero risk, but
and the interest rates are high.
Yeah.
So look, I don't think, I think it's gonna be tough.
Yeah. I think, and again, this is just anecdotal. I think, obviously I speak to a lot of emerging managers. I think fundraising has been incredibly hard over the last couple of years. I think there has been an expectation that will start easing up over the kind of coming years. But I've had GPs tell me they had hard commits from LPs who said that they would come in, after XYZ hurdle had been reached. Hurdle gets reached, LP pulls out, right? Like, as in, they're like, well, it's changed. It's no longer, we no longer feel kind of comfortable with that, with the risk profile, whatever it might be. I'm not even sure what the specifics are as such, right? But the point is that I think for first time fund managers, you are both having to sell your vision as well as build those relationships. if there is something else that is already kind of, and you've got to fight even further, or push more uphill to get over that kind of initial, or get to that first kind of check, as compared to maybe 5 years ago, right? So that's become hard. And I think the other problem now for existing managers is, okay, to your earlier point, if those exits aren't happening, if there isn't capital being returned to LPs, if there's no DPI, how do you go out and raise your next fund? Because, you're going to be sitting there going, well, we're looking to raise now from a 150 million fund, we want to raise a 300 million fund or whatever. Okay, yeah, but you haven't returned me any cash from this last one. Why would I double down now, right? So I think there is clearly kind of this it's not an issue, it's not a problem. I think it's where the market is, right? But how long it's going to take to play out, I don't know. And I think, yes, to your point, some of the geopolitical stuff that's happening, be it here, be it the US, be it elsewhere, obviously is going to impact that.
But what I would say is, so I've got a very close friend of mine who just left a major private equity firm about 3 months ago, and he raised 100 million. He's already raised it. He got his commitment.
Wow. So if you have the relationships, it's still doable.
But he spent 10 years in that firm.
Yeah.
And he carved his niche. His niche was health tech, right? And I think, and manufacturing. And I think,
which are both incredibly hot areas at the moment. Like, in terms of investment, we see more health tech, med tech deals, more deep tech, hardware, like that's the stuff that people are investing, like a very R&D kind of intensive business.
And I think, look, I think if you're, the good thing is he focused specifically on these are the verticals, and he said this is why the UK is an attractive place for it to be done.
Yeah. Because
of the defensibility, because of the IP, maybe because of the universities, because of, the capabilities of the UK. So I wouldn't say, I think if you just have to carve your niche out, and I think there needs to be a compelling story, which there can be, if you're the right fund manager, right? And if you've got the right track record and you access to those deal flows, and it's in a niche where actually, there's not a lot of competition in that specific niche. For example, he writes between 2 to 15 million pound tickets. He's competing with funds that write there's not that many funds.
There's not many out there, yeah.
So he's carved his niche, but then again, you've got to be really, really confident that there's an LP base for that niche.
Yeah.
Like even for us, right, when we launched Sentient, it was a niche, but it appealed to. It's like marketing, right? Knowing your customer, right? So we really knew, okay, this is the type of individual it's going to, or fund or family office is going to appeal to. So we did our branding, our marketing, our talking, our communications very much focused on them.
Yeah.
But if you lose that kind of, maybe there's only 50 because you've disregarded the whole market, you need to really make sure that you kind of get it right for that group.
You've either got to get it right for them, or you've got to go broad and hope that other people get captured.
But I think the broad is harder now because like the ones that are really kind of covering that or taking that area are kind of your second time fund managers, your third time fund manager, all the brand names.
Yeah, it's less risky. Yeah. The LPs don't have to do as much diligence. There's not as much of a courtship period. It's sort of like, okay, well, I've got X to allocate. This guy seems sensible. We've invested him in the past, or we know him from X. Okay, let's deploy there. I think obviously differentiation is always very good. I think there has been a plethora of undifferentiated sort of funds, or very similarly differentiated funds almost, that have kind of cropped up over the last several years. And I think a lot of this is going to shake out. I think it is, it's worrying for, like, I look at it slightly from the perspective of a lot of emerging managers that have come up over the last several years have been from sort of underserved markets, right? So whether they're female focused or, focused on minority, ethnic, and so on and so forth. And the problem is that if those funds fail or, aren't as good as they were intended to be, the chances of LPs coming back into similar funds in the future shrinks because, it's sort of that once bitten, twice shy narrative. But look, let's see. I want to move on because actually, we'll get into Euretta in a second as well. But one of the things that I was really interested in was you specifically focused on what you called HAIL, right? So hardship, alienation, illness, and loss as a thesis. And obviously we've talked a fair amount about kind of some of the things that you went through. But how do you look at trauma as a driver for entrepreneurial success? And how did you use this as a metric for determining or predicting potentially breakthrough founders and ventures, right? Because I know that was in part driven, as you said, by your own experiences, so I'm sure that had influence. But one of the things, and again, we'll talk about it more when we talk about Euretta, but one of the things that I think is really hard to quantify is, well, how do you, so lots of people go through trauma, not all of them are going to have breakthrough success. So how do you figure that out? But yeah, I'd love to understand kind of more about how you approach that.
Yeah, look, and I think I'll tell you where we are kind of now, but first, and then we can go back. But essentially, what we've realized, and obviously what the science and the academics have basically said, is it's not actually the event that you're measuring; it's the individual's process of overcoming that event.
Yep.
And that can be measured. That's the key to it, right? So, for example, if I lose my father, but you lose your cat, it might equally be as traumatic for you. For example, you may not have parents, and your cat is the most important thing for you. So that level of trauma is, you can't. It's very different for different people. What you can measure is the mindset, the resilience, the overcoming of that adversity. That's what you can measure. And actually, that's the most important thing in terms of what we've realized now. We've spoken to post-traumatic growth specialists. There are actually people in this world that do this and talk about these events. Now, if we go back, when I first started investing, and like in 2016, it was just a hunch, right? I was like, so my dad, it kind of came from him, right? So my dad ran an accountancy practice for the last 5 years of his life. Before he passed away, it was his own. And what we realized when he passed away was, which he never told us, that he was only helping people that had gone through extreme levels of hardship in his accounting practice. Hardship, alienation, illness, or loss, so the HAIL founders. And he wasn't charging them for the last 5 years because he was either very much like, I need to give back to these people, but also he was like, I don't want to, I've paid taxes now, I don't want to earn more than a certain threshold. So, you kind of get the Indian
maybe
in him.
pragmatic, but
both, right? Yeah. So anyway.
Well, both sides are very Indian, right?
Exactly.
Like help others, but also save money. That's,
exactly. So
that makes sense. Yeah.
so it was crazy, right? Because at his funeral, I mean, you'll know it as a kind of, like, he would have been, I think, 74, 75 now. Actually, no, he would have been 79 in Jan. And that generation and the relationship with the kids was a bit distant. It wasn't very, let's not talk about things.
Yeah.
Right? Exactly. So, and actually at his funeral, 120 people turned up.
Wow.
It was quite close to I think, Hendon. And of those 120 people, there were Eastern Europeans, Indians, Nigerians. There were English people as well. But they were grown adults, and they came and they were in tears. And they were like, "Your father helped me. We had nothing. Your father helped me. We had nothing." And I was like, "Okay, I didn't realize this." And then so when we went back home, eventually after a week after whatever, I had to sell his accountancy practice, and I realized he's not been charging anyone. So I called all of these people, and they were like, "Look, he's been helping us because we nearly lost this. We couldn't do this. We couldn't afford this." And I think that's when actually it triggered this kind of this HAIL concept of hardship. And I was going through my own hardship because it was a very sudden death.
Yeah.
So I was like, well, actually, and everyone likes the underdog story. So in my mind, I was like, well, maybe that is a thing, right? Maybe people that have gone through these really difficult events have an ability to bounce back and overcome greater than others.
I mean, it ties into the whole kind of migrant founder story as well, right? Where often migrants who've been through a huge amount of hardship to get onto safer shores, but don't have an opportunity to do, to work in the normal economy, they're often the founders that go out and do incredible things because they have to, right? And I think it comes back to your point around it's not the event that you're measuring, it's the individual's process for managing that event or overcoming that event, right? So the fact that someone has, for example, crossed God knows how many countries, fleeing for their life, with kids or with their, with their elderly parents or whatever, like to make that journey. I think we don't talk about this, we talk about it in very sort of obviously sympathetic tones, but I don't think we talk about it in terms of like how clearly traumatic that has to be. But it shows resilience. It shows an ability to have a strategy, to figure things out, to pivot and work. I mean, this, this sounds like a really crappy LinkedIn post, like what I learned about B2B SaaS from fleeing Afghanistan or whatever. But I don't mean it in that way, but it does show that they have this grit and determination. And therefore, yes, if they do go out and then build something, then it's quite possible that that grit and determination that they've already shown will be repeated, right?
Yeah, and look, it's amazing, right? Because the most successful entrepreneurs or founders that I've met, unicorn founders and stuff, and we've analyzed a lot of them because of the new project. They won't even bring this up as a traumatic event. They're just like, yeah, what other option did we have?
Yeah.
Right. So then also and that's where it gets really interesting, right? Because you actually want people to, the actual, some of the best entrepreneurs that I've met, and I try to not give too many biases. That's the whole point of Euretta, right? But like, they're like, yeah, we had no choice and it was just a thing. Like, but it's interesting. I think as you go, a lot of what we've realized as entrepreneurs go along their journey and become more successful, they start reflecting, they start connecting the dots. I think Steve Jobs talked about connecting the dots of your individual's life and then finding what that means. And I think that was great when I started investing in 2016, because we were asking questions which actually allowed founders to really start trying to connect the dots about why they're doing what they're doing and how they got there. And then you can start getting hints about, is this really what they want to be doing? Or is it something which is maybe a 3 to 5 year project? Or is it a 10, 20 year project?
Just as you were talking just then, I literally was like having flashbacks to when I tried to build my own tech business. And it was really clear, like the dots weren't there. Like it was a decision that I made, not driven by purpose. It was driven by probably ego or something else. And yeah, so it was a weird moment. Like I felt myself, okay, maybe if I'd approached it differently, that might have been.
But I think that's the thing. And I think, and that's, I really think the most important thing. And I don't think a lot of investors ask this. And I don't think a lot of entrepreneurs will answer it in the right way.
They ask it in terms of, why are you the right person to build this business? But it's much more about domain expertise or whatever. Like that's what they're testing for, right?
But so for example, domain expertise is the how. Yeah. That's not the why.
It's not the why. Yeah.
And again, and I get it, right? Like if an investor's coming to me and asking for me to put money in, I'm going to put my best foot forward, right? And I think that's the most amazing thing. The most successful relationships, irrelevant of investing, or it can be marriage, it can be friends, is when you're just authentic to each other, right? And I think that's the reason. My fundamental belief is the reason why venture capital and a lot of investing fails so much is just because there's lack of authenticity on both sides.
Yeah, it's an adversarial arrangement rather than a collaboration. Often.
Yeah, and it's like, and the thing is, you only really know someone's authenticity after time of spending time with them.
And that's after you've invested the money and after.
Exactly. And you might be lucky that, if you're a Series D investor, that me and you have been having coffees for the last 2 years because you've been on our radar. But generally, before that,
seed, that's not happening.
Pre-seed, seed, even Series A, maybe you can argue Series B, you're investing a lot of money in people. And an entrepreneur is taking money from an investment firm, which is also a big commitment on both sides. And
it's not just taking money from the investment firm. It is actually taking money from a partner, right? Like as in a partner is responsible for that investment. It is their name it's often they will be on the board. It's their name that's attached to that investment, right?
And a lot of them making these decisions after 3 to 5, maybe 7 meetings.
Yeah, and it's interesting because again, post investment, we've had a ton of people on the podcast who've said this in the past. I think I've said it several times. The average VC founder relationship lasts longer than the average UK marriage.
Yeah,
but that's after they've already committed again, right? Like so, and you think about that, most people when they get married, I was probably not one of these people, but will have spent a fairly significant amount of time with their partner beforehand. But to your point, that isn't what so it's almost like an arranged marriage, but probably less healthy than even an arranged marriage can often be. So I want to. I mean, the question then arises, how, like, because I understand the direction of thought that you are taking, but even then, it's still only off the back of 3 or 4 or 5 meetings, right? So, because you've got to. How do you get that authenticity, that rawness out of a founder? Because at the end of the day, again, it's an asymmetrical relationship, right? You as an investor, there is power. As a founder, you are coming to the investor for money. As a founder, you're always, you are almost conditioned to say whatever it is that you think is the right answer in order to get the investment, whether that's authentic or not. So how were you able to really get the truth, to be able to judge is maybe a strong word, but to understand that founder's perspective and their why? How were you able to break through that in such a short time?
Look, I mean, on the first fund, we invested in 30 companies, right? So we got an IRR of 25%. So we did well. We had 4 exits. When I first started investing, right at the beginning, actually the investments we made during that period were not as good. I lost what was my biggest strength as an individual, and I think that came across in the type of founders that we backed. And then that guard hit, that guard kind of the entrepreneurs kind of, maybe coming up, so you're not really getting to know them. And I think I'm best when I'm true and authentic, right? That's when my biggest skill, I would say, is when I say what I think, and I try to be who I am. I don't try to be someone that's an investor. Yeah. I'm not someone that's, I was when I worked in banking, and I was just, oh my God, I have to, conform. But I think as you start learning and you're realizing, as you kind of grow a bit older, you realize actually the reason why I'm best as an investor, and I'm not the best investor, there's obviously better, but I'm best as an individual in whatever I'm doing when I'm just true and speak the truth about what I'm trying to kind of obviously achieve in this transaction. But also that sense of authenticity hopefully will come across in a way which I'm truly authentic. And then that allows the founder or the entrepreneurs to be authentic.
Well, I mean, like you mentioned the LinkedIn post you put out 3-4 weeks ago about having made the decision to shut down Sentient and return capital to the LPs. I would argue that it is very rare to see an investor, really speak the truth in that way, right? Like the why you decided to do it. There was no, there was no sort of hiding the rationale behind it. There was nothing that felt like this wasn't, you didn't wake up one morning and say, yeah, this is what we did, I'm going to write it on LinkedIn, right? Like there was nothing false about the narrative there. And that was why I reached out, because I was like, okay, well, this is clearly someone who is not afraid to speak the truth and to tell his story in that authentic way, which I think, others in your position might have, well, the market conditions were this, and, they may have said, well, we felt that the insecurity in the elections in various places were not helping and all sorts of stuff. But you were very frank in that post. And I think, that came across like massively. I want to move on to Euretta, right? Because this all kind of leads up to Euretta. It sounds like, certainly from my understanding, right? So Euretta aims to quantify personal traits and forecast success. So firstly, I want to understand whether mindset truly can be quantified, because that feels like a really difficult problem. And given that this is quite a subjective topic, how have you been able to convert that into a more data-driven analysis, right? And it would be interesting to see kind of what trends or patterns Euretta has already uncovered in the traits of successful entrepreneurs and founders, because you mentioned earlier in these interviews you saw these moments with them, but I would imagine that there probably are clusters that have been quite surprising.
Yeah, no. So again, I think it goes back to the start, really. So obviously, we started backing founders from the first fund of HAIL, so hardship, alienation, illness, or loss, and then in 2023 January, sort of the fund performance came out, the first one, and there was significant outperformance of individuals that had gone through hardship by 4x versus the ones that hadn't. Right. So essentially, we took this data. And naively, I gave it to King's College, some neuroscience at King's College. So I said, look, is there, can you maybe run some academic, research against this, or to see if there's actually anyone's ever done this before? And if there is a link between people that have gone through hardship, alienation, illness, or loss and entrepreneurship. And they wrote a 65-page report.
And so clearly the answer wasn't just no, there's no correlation.
Yeah, there was a correlation, 95% significance level, right? And then it was such a phenomenal report, right? We still have it, obviously, and it goes into entrepreneurs that have been based in Afghanistan post-war, and talks about how they navigate entrepreneurship in Afghanistan, where the political environment's so difficult. And then it goes into blind entrepreneurs in India. And then it goes into your Silicon Valley traditional entrepreneur. And then it goes to earthquake survivors. And it specifically starts talking about, how, for example, individuals that have been through these events have much more of an empathetic knowledge base of their customer. Because they've been through an event, they understand their customer more, because that customer, they were on the battleground.
There's that empathy, yeah.
So then you start looking at that, right? And then, and at that point, it was like, okay, this is really interesting, right? And you want it to be something that comes out positive, right? So then what we did was we were like, okay, let's see if we can take this further. And I think parallel, the rise of artificial intelligence, the rise of language learning models, and I always knew this anyways, but we got it reclarified, that investors base 99% of their decision on the founders.
Yeah.
But very few of them run any scientific evidence.
There's a couple that are trying.
Yeah, trying, right? But again, I would link that to correlation, not causation.
100%. There's a lot of survivorship bias in there, right?
Yeah. So then we realized that also, so they don't really do a lot on the management reporting or management due diligence or founder DNA, which is the key to their decision making. So we realized there was a gap in the market there as well. So what we decided to do was, okay, we need to actually try to see if we can quantify entrepreneurship potential. So we went to the University of Cambridge, Judge Business School, and said, look, I've done this work on HAIL, on hardship, on entrepreneurship. Here's the papers. What do you guys think? Can we do something to try to quantify entrepreneurship? And then the Judge Business School, let's create the first entrepreneurship-based psychometric tests. There's none out there.
Which is incredible now that you come to say that. That's mad.
People look at the big 5 traits, people look at Myers-Briggs, but they're indexed for the ordinary population. So, and obviously entrepreneurship traits are very different.
For employment, essentially.
Correct, right? So we're like, okay, we'll do that. So, and then Cambridge actually said, okay, well, if you do this, you cannot base this traditionally on HAIL, on hardship. We have to actually start again, but we can, of course, put that data set into the literature reviews that we kind of create. So then, they spent around 6 months with us, with Unicorn. I got some Unicorn founders. I got founders that had, built businesses that raised, Series C, Series D. I got the likes of, for example, Tessa from Olio, gave me some input and things. And we literally kind of identified, the main plan was identify traits associated with an exceptional entrepreneurship. How do we kind of bring that all on one piece of paper? And we identified 27 based on these literature reviews that we ran over the last 7 months. And then you obviously take those and then you start forming the basis of a psychometric test. And then, of course, whilst we were capturing this data, I was adamant that when we were doing the literature reviews, and actually we started running these questions against the general population, and I was adamant that we capture the demographics. So we capture migrants, we capture whether they've had hardship, illness, loss. We captured whether they were elite athletes or they played something, elite, because everyone has these kind of conversations that entrepreneurs are the best at this, that whether they were sort of male, female.
Whether they had presumably neurodiverse tendencies as well.
Correct. So we asked these, and then so we got that around from 2,500 people, and then actually the data started coming out. So we have this data now in terms of, if you look about insights, for example, like people that have been through extreme levels of hardship, have greater levels of emotional intelligence when it comes to building technology companies or any companies, and they are much more emotionally connected to their staff or their employees because of these hardships. Traditionally, women are meant to be less confident or promote themselves lesser when it comes to fundraising or pitching. Or our data on the 2,500 says that's not the case.
Okay, so as in so the trope that they are less confident when they're pitching is untrue.
For those 2,500.
For those within those 2,500, okay.
Yeah. However, they over-index when it comes to leadership versus their male counterparts. Then you start putting together first-generation migrants that are female, that have been through hardship, and then how do they become on those 27 traits? How do they over-index on continuous learning? Do they over-index? And so we have a lot of the starts of this data. We're planning to roll that out across 100,000 people over the next 6 months.
Kind of want to do it myself at this point.
Yeah. Well, and in parallel, we're doing,
and hopefully have it tell me that I am an entrepreneur. Otherwise, I'll be really
no.
pissed,
I don't look,
or at least exhibit some of the traits. Yeah.
No, so I think it's like there is it's kind of like there's no right or wrong.
No, I know.
Right? It's kind of there's
where do you
insight
sit
in terms
within
of,
that?
and where do you over-index on?
Yeah.
Where are you strong on for entrepreneurial traits and qualities? So I think it just provides that insight. So, we kind of started at Hale, but actually then we widened it back. Yeah. But actually Hale
is part of
Migrant is such a big part of it. And a good thing about Hale is it goes beyond ethnicity. It goes beyond sex. It goes beyond... It just talks about an individual's life experience.
It's really interesting. I've had this conversation, but not in such specific terms, with a number of people. A good friend of mine, Alex McDonald, was the founder of Velocity Black, which exited last year to Capital One. He and I at one point were looking to, we never got this off the ground, but potentially set up a charity focused on not even underrepresented, like people who would not even have considered themselves as being able to be entrepreneurs, right? So how do we get grants in the hands of someone that's grown up in a council estate, maybe has been subjected to kind of, drugs in their environment, or, their schooling has not been amazing. They haven't had opportunities, they don't have a network, they don't have relationships, but they've got through that and probably do have that potential, but no one's ever said to them, you have that potential, right? And here's a bit of cash to get going with. And I think a lot of us that work within kind of the ecosystem, I see it all the time. The founders that are hungriest are the ones that are not doing this because of, they want to build a unicorn. There's something that just, is within them that they want to take this. And often, again, if you look at those founders, you will find markers of that in their backgrounds, which aren't necessarily obvious otherwise, right? But I think the point is that, those 27 traits are, because it's interesting. I did this, sorry, it's a bit of a rambling kind of reply stroke question. I did this thing when I moved back here in 2015, I did the Strengths Finder 2.0, which is run by Gallup, which is, again, there's 33 sort of traits that I think they have that they have within them. And it was actually quite surprising, because not that I live by those traits or what that told me, but actually when I look at all of the things that I've done over the course of the last 10 years since I moved back, they fit into categories where those traits were prevalent, or where you can see quite strong signals of that. So, and because I wonder, right, because the natural question here then is, if you test Joe Bloggs on the street and they have 20 of the 27 markers, but they're currently an employee at Marks and Spencer's, or, at Shell, or at BP, or at, Deutsche Bank, or wherever it is, does that, does it then follow, A, that they will be great entrepreneurs, and B, would they ever take that jump? Because one of the things about entrepreneurship is, if you have that kind of entrepreneurial trait, often you kind of end up doing it irrespective of anything else, right? So I guess sort of the two questions are, do you think this is a tool that can help people identify whether they should go down an entrepreneur, whether they would potentially have more success going down an entrepreneurial path, and therefore make that leap? Or is it a tool that you think could be used for existing entrepreneurs, to potentially assess them from, say, an investment perspective, or whatever that rationale is? I mean, like, what is the kind of outcome?
Yeah, so there's two answers to this. I think the first bit is like my business plan for the next sort of 18 months. And essentially our tool is going to integrate with venture capital and private equity's due diligence flow.
Got it.
So we're going to integrate into their solutions to start with, right?
Yeah. So this is your founder DD tool, essentially.
Correct, right? So, and we will, the founders will do psychometric tests, but we're also integrating with, video calls, emails, and everything is being ranked and vetted against those 27 domains. So it actually starts to truly unbias the system. It starts to supplement the investor in terms of some of their decision making, some of their investment decision making,
and it helps them avoid the biases and heuristics that they may be built up over time.
Great, and actually, we have one solution which you can buy, which actually it removes everything up until the end of the first meeting, so up until the second meeting, right? Because we built a tool which essentially you can put your pitch deck into our tool, or all of your applications for funding as an investment house, or your transcripts, and you can put it in there, and it unbiasedly scores based on a commercial DNA and identifies within your investment criteria which are the ones that score higher, and the investment house will set that commercial DNA to start with.
So it can be internal. They don't need to so they can decide what it is that they're looking
so
for.
and again, we summarize a lot of this stuff in an AI driven report which we give to the investment house. So now suddenly, like, you're going into a first meeting as an investor with all this information which is unbiased, right? So it's great, right? Suddenly now, you and I now we're on similar playing fields versus, I knew you because we went to school together and this and this. So it kind of, I'm not saying that's going to disappear, but this allows a lot of other people to just get a fairer shot at getting into the room, because a lot of what we've realized is a lot of founders can't even get into the room.
Well, we all know the stats. Stats have actually gotten worse in the last couple of years, but less than 2% goes to female and minority founders, and of that 2%, I think 1.5%. Less than 0.5% goes to minority ethnic founders, as an example, right? So they're not getting in the room, they're not getting the funding.
No.
And if you can effect change whereby it is easier for those people to get in the room, and it becomes more apparent that they are potentially better bets to be taking, then you can start to really shift that.
Yeah, you're right. And I think, look, but that kind of targets the beginning bit of the filtering.
Yeah.
But then the second bit is, because we're an AI company and we're constantly continuously learning, because we're integrating with the conversations and the psychometric testing and all the sort of beginning to end, the system will get smarter.
Yeah.
And start saying, okay, this founder is showing this level of, traits or etc. Hello, Miss Investor, you didn't ask this specific question, but other investment houses are asking this specific question. So you're missing insight there. You should be asking these types of questions. And then the system starts getting smarter, right? So actually for investors, you hope it supplements them becoming better investors, and removes biases up until the point where, their secret sauce or their gut kind of starts coming to play.
Yeah.
And which we're not going to remove. That's an important part, but we're supplementing that with insight and predictability.
Yeah.
So that's kind of the day one plan. Now, the day two plan and the bigger vision is, I have a very vivid kind of dream of this, a lady in India that is in a village and she goes back and forth, picking water up for her family and for the community. And then she comes home and, like a lot of Indian mothers in the village, kids are there, they're teaching them and they're cooking and they're doing everything. Now, those are entrepreneurial traits. The going back and picking up water is grit, is resilience. Providing, prioritizing is that. Then suddenly multitasking, suddenly leadership to make sure they come, and suddenly setting an example. These are entrepreneurial traits. Now, the problem is they don't know what venture capital is. They don't know what private equity is. They don't have the opportunities that you and I have sitting here. But why not? Why does that chap you mentioned in M&S not have the opportunity just because they haven't been educated to understand these specific areas? Or maybe they've just kind of thought it's beyond them.
Well, outside of London, most people just don't, certainly in the UK, outside of London, a lot of entrepreneurs just don't think that they can even raise VC or raise angel investor or whatever, because it's just so alien. The education isn't there, the access isn't there, the people aren't there, and it just, so they just assume they can't. And actually, as a result, demonstrate again that grit, resilience, that entrepreneurial sort of drive, because they end up just bootstrapping and building, off their own steam.
And look, I guess the counter argument is going to be from an investor. Well, if okay, the lady in India is slightly different, but if the person in M&S or whatever is, if they can't upskill themselves, right, to get in front of our room, then they don't show the level of determination. So that's the counter argument. But I'm a firm believer that we're all born the same in this world, right? And then it comes down to fine, you get certain privileges, and fine, you get certain things that kind of change and luck and stuff. But it just comes down to self-belief, I think. And I think a lot of people, especially me, fine, I've done quite a lot in my life. I feel like I still always lack that self-belief. I was mentioning why I launched the fund. And I think if that person M&S or that lady in India, I think it's just about giving them that level of self-belief.
It's that external, it's that validation that they can.
To say, like, actually, okay, here's the, this is what all the VC and PE investors are doing, and this is who they're backing. Now imagine if I can go to them and say, look, this is the assessment they're doing. This is how they are pitching their products. This is how they're positioning their brand. This is how they're, managing sales meetings, because we have all that data. And imagine I'm going to these types of individuals and saying, look, why don't you actually compare yourself against them? Why don't you pitch your business? And if you start saying to this objectively, you have maybe 1% versus like you're kind of really low quartile, but actually there's a clear route for you to get here, and we can support you on that route, then suddenly the M&S person or the lady in India will be like, either, this is not important to me, I'm going to get back to my sort of normal job, and, I just don't have time, things are more important to me than being an entrepreneur. That's completely fine. Right. But I think
at least knowing that you have the option.
Correct. Yeah. And I'm sure, you would have had friends that have been like, oh, like, you're so great, you've just launched your own company. You know, I wish I did it. I wish I did
I
it.
have a ton of friends who are like lawyers and doctors who are like, we've been doing this 20 years, hate it,
Exactly.
but don't know how to get out of it. And actually, the other point that I think, you know, is really important here is, you know, we've been talking about this under the lens of VC and so on. Actually, like, entrepreneurship is not about just venture, right? Like, at the end of the day, entrepreneurship is, you know, for the lady in India, it's set up a dairy farm, or it's or it's a coffee shop, or it's what, like, it doesn't matter. It's and let's face it, the world needs more people, or the world needs people that are willing to go out and do this sort of stuff, just as much as the world does also equally need people who work for those people. Because ultimately, if everyone's an entrepreneur and no one's actually, you know, coming up the other end to kind of do the work that needs to be done, then, you know, that equally is not a particularly useful situation to be in. But the point is, I think I talked about this with Piers Linney, you know, access to opportunity should be equal for everyone, like, irrespective of what they then do with it. But, like, at least everyone should be able to apply for that job, or, you know, do that thing, or at least be invited to that party, right? And the way actually he talks about it really interesting. He goes, you know, equality, because we're talking about DEI, right? So he said equality is being invited to the party, inclusion is being asked to dance, right? And I think that's a really, like, interesting way of framing it, right? Manish, look, again, I think we could probably go on for a long time about this, but I wanted to kind of close off with one final question, which I ask all our guests, or have recently been asking all our guests. So what is one thing that you have a really contrarian conviction about from any area of life, whether that's work, politics, socially, or at home? What is the hill that you would die on defending?
You know, even though you sent me this question before, I still was like, this is a tough question to answer.
No one has yet given me a truly contrarian response. Well, certainly no VC has. Let's put it that way.
Contrarian view. Have you answered this question?
No.
So I was going to ask you to answer it first. I don't know. I'm gonna have to send you this. I need to think about this.
We will come back to it. I mean, actually, so my contrarian opinions are, there are no contrarian opinions, right? Like, or a better way of putting it, it's very easy to be contrarian. It's very hard to be contrarian and right. But Manish, look, it's been incredible speaking to you today. For our audience, where can they find you online? Are you on LinkedIn, Twitter? Where's the best place for them?
Yeah, LinkedIn's great. And of course, Euretta.co. When I look at the company website, but LinkedIn's best.
Amazing. Well, Manish, thank you so much for joining me. It's been an absolute pleasure having you in the studio.
Thank you very much.